Hello students, welcome to the lecture on growth and development of Indian insurance industry. And after this lecture, we will be able to learn the following objectives. Explain the insurance companies in India. Define India's insurance market. Describe the history of insurance development in India. Explain the special features of life insurance. Understand the types of life insurance and write life insurance. Let's start with what is the Indian insurance industry. Although it accounts for only 2.5% of premiums in Asia, it has the potential to become one of the biggest insurance markets in the region. A combination of factors underpins further strong growth in the market, including sound economic fundamentals, rising household wealth, and a further improvement in the regulatory framework. The insurance industry in India has come a long way since the time when businesses were tightly regulated and concentrated in the hands of a few public sector insurers. Following the passage of the Insurance Regulatory and Development Authority Act in 1999, India abandoned public sector exclusivity in the insurance industry in favor of market-driven competition. This shift has brought about major changes in the industry. The inauguration of a new era of insurance development has seen the entry of international insurers, the proliferation of innovative products and distribution channels, and the raising of supervisory standards. By mid-2004, the number of insurers in India had been augmented by the entry of new private sector players to a total of 28, up from 5 before liberalization. A range of new products had been launched to cater to different segments of the market, while traditional agents were supplemented by other channels including the internet and bank branches. These developments were instrumental in propelling business growth in real terms of 19% in life premiums and 11.1% in non-life premiums between 1999 and 2003. There are good reasons to expect that the growth momentum can be sustained. In particular, there is huge untapped potential in various segments of the market. While the nation is heavily exposed to natural catastrophes, insurance to mitigate the negative financial consequences of these adverse events is underdeveloped. The same is true for both pension and health insurance, where insurers can play a critical role in bridging demand and supply gaps. Considering that the bulk of the Indian population still resides in rural areas, it is imperative that the insurance industry's development should not miss this vast sector of the population. Let us now talk about the insurance companies in India. Following are some of the top insurance companies in India. Life Insurance Corporation of India. The Life Insurance Corporation of India is undoubtedly India's largest life insurance company. Fully owned by government, LIC is also the largest investor of the country. LIC has an estimated asset of 8 trillion. It also funds almost 24.6% of the expenses of Government of India. Established in 1956 and headquartered in Mumbai, Life Insurance Corporation of India has 8 zonal offices, 100 divisional offices, 2,048 branch offices and a vast network of 10,02,149 agents spread across the country. Life Insurance Corporation employees. Following is the employee breakup of Life Insurance Corporation. 10,02,149 individual agents, 98 brokers, 242 corporate agents, 42 banks, 79 referral agents. Life Insurance Corporation of India Awards. Life Insurance Corporation of India has won the following awards in 2011 to 2012. Reader's Digest, Dainik Bhaskar Group, Super Brands, Bombay Chamber of Commerce, Asian Leadership Awards, ABCI, ET Brand Equities, Most Trusted Star News, Customer Centric Brand Award, CNBC Awards, Tata AIG Insurance Solutions. Tata AIG Insurance Solutions, one of the leading insurance providers in India, started its operation on April 1, 2001. A joint venture between Tata Group 74% stake and American International Group Inc. AIG 26% stake, Tata AIG Insurance Solutions has two different units for life insurance and general insurance. The life insurance unit is known as Tata AIG Life Insurance Company Limited, whereas the general insurance unit is known as Tata AIG General Insurance Company Limited, AVIVA Life Insurance. AVIVA Life Insurance, one of the popular insurance companies in India, is a joint venture between the renowned business group Dabur and the largest insurance group in the UK, Aviva Place. Aviva Life Insurance has an extensive network of 2008 branches and 48 bank assurance partnerships spread across 3,000 cities and towns across the country. There are more than 30,000 financial planning advisors, FPAs, working for Aviva Life Insurance. It offers various plans like child, retirement, health, savings, protection and rural. MetLife Insurance. MetLife India Insurance Company Limited is another popular player in Indian insurance sector. A joint venture between the Jammu and Kashmir Bank, M. Palonji and Co. Private Limited and other private investors, and MetLife International Holdings Inc. MetLife Insurance offers a wide range of financial solutions to its customers, including Met Suraksha, TROP, Met Mortgage Protector and Met Suraksha Plus, etc. It has its branches situated over 600 locations across the country. More than 50,000 financial advisors work for MetLife. ING Vyasa Life Insurance. ING Vyasa Life Insurance entered into the Indian insurance industry in September 2001. A joint venture between ING Group, Ambuja Cements, Exide Industries and NM Group, ING Vyasa Life Insurance uses its two channels, with the alternate channel and the tied agency force, to distribute its products. The first channel has branches in 234 cities across the country and has got 366 sales teams. On the other hand, the later one has more than 60,000 advisors. Currently, ING Vyasa Life Insurance has tie-ups with more than 200 cooperative banks. Birla Sun Life Financial Services. Birla Sun Life Financial Services is a joint venture between Aditya Birla Group and Sun Life Financial Inc., Canada. It has got an extensive network of more than 600 branches. More than 1,75,000 empaneled advisors work for Birla Sun Life, which currently covers over 2 million lives. Max New York Life. Max New York Life Insurance Company Limited is one of the top insurance companies in India. A joint venture between Max India Limited and New York Life International, a part of the Fortune 100 company, New York Life. Max New York Life Insurance Company Limited started its operation in April 2001. It currently has around 715 offices located in 389 cities across the country. It also has around 75,832 agent advisors. Max New York Life offers 39 products which cover both life and health insurance. Bajaj Allianz. Bajaj Allianz is a joint venture between Bajaj Finserv Limited and Allianz SE, where Bajaj Finserv Limited holds 74% of stake, whereas Allianz SE holds the rest 26% stake. Bajaj Allianz has been rated AAA by ICRA for its ability to pay claims. The company also achieved a growth of 11% with a premium income of 2,866 crore as on March 31, 2009. Bharti AXA Life Insurance. Bharti AXA Life Insurance, one of the top insurance companies in India, is a joint venture between Bharti Group and world leader AXA. Bharti holds 74% stakes, whereas AXA holds the rest of 26%. Bharti AXA has its branches located in 12 states across the country. It offers a range of individual, group and health plans for its customers. Currently, more than 8,000 employees work for Bharti AXA Life Insurance. Let us now move on to the next topic, India's insurance market. Insurance in India used to be tightly regulated and monopolized by state-run insurers. Following the move towards economic reform in the early 1990s, various plans to revamp the sector finally resulted in the passage of the Insurance Regulatory and Development Authority (IRDA) Act of 1999. Significantly, the insurance business was opened on two fronts. Firstly, domestic private sector companies were permitted to enter both life and non-insurance business. Secondly, foreign companies were allowed to participate, albeit with a cap on shareholding at 26%. With the introduction of the 1999 RDA Act, the insurance sector joined a set of other economic sectors on the growth march. During the 2003 financial year, life insurance premiums increased by an estimated 12.3% in real terms to INR 650 billion, USD 14 billion, while non-life insurance premiums rose 12.2% to INR 178 billion, USD 3.8 billion. The strong growth in 2003 did not come in isolation. Growth in insurance premiums has been averaging at 11.3% in real terms over the last decade. Insurance development and potential. Notwithstanding the rapid growth of the sector over the last decade, insurance in India remains at an early stage of development. At the end of 2003, the Indian insurance market in terms of premium volume was the 19th largest in the world, only slightly bigger than that of Denmark and comparable to that of Ireland. This was despite India being the second most populous country in the world as well as the 12th largest economy. Yet, there are strong arguments in favor of sustained rapid insurance business growth in the coming years, including India's robust economic growth prospects and the nation's high savings rates. The dynamic growth of insurance buying is partly affected by the changing income elasticity of insurance demand. It has been shown that insurance penetration and per capita income have a strong non-linear relationship. Based on this relation and other considerations, it can be postulated that by 2014, the penetration of life insurance in India will increase to 4.4% and that of non-life insurance to 0.9%. What will it take to realize this potential? While the macroeconomic backdrop remains favorable to growth, there are still major hurdles to overcome in order for India to realize this growth potential. The proliferation of bank assurance is rapidly changing the way insurance products are distributed in India. This will also have strong implications on the process of financial convergence and capital market development in India. Health insurance is still underdeveloped in India but offers huge potential as there will be increasing needs to purchase private health cover to supplement public programs. Likewise, the deficiencies in current pension schemes should offer significant opportunities to private providers.
Life insurance is a financial product that covers your risk of death by paying money to your heirs in case you die. All policies follow the same basic principle. You first pay money to an insurance company. If you die, the life insurance company pays a certain amount of money to the persons that you have chosen in advance, called beneficiaries. The money that the insurance company pays your beneficiaries in case you die is called the sum assured, and the money that you pay to the insurance company is called the premium. People buy life insurance for different reasons. Some people buy life insurance mainly as a way to provide their families with money in case of death. But life insurance also offers other advantages. First, the premiums you pay to the life insurance company are tax deductible from your income. The more money you put into life insurance products, the less you have to pay in taxes. Second, some life insurance policies can also be used as savings schemes and provide returns every year on the basis of the sum assured. The two most important types of life insurance are term life insurance and whole life insurance. Term life insurance provides pure life insurance coverage. During the length of the policy, you have to regularly give money, the premium, to the life insurance company. In exchange for these premiums, the life insurance company promises to pay your beneficiaries in the event you die. But what happens if the term life insurance policy expires before you die? In that case, the life insurance company does not give you or your beneficiaries anything back. Now, let's talk about whole life insurance. With whole life insurance, you also have to pay premiums regularly to the life insurance company. When you buy whole life insurance, the insurance company uses your premium in two ways. Part of your premium is used to give you insurance, and part of your premium is used to give you savings that will be returned to you later. If you die during the period of the whole life insurance policy, the insurance company will pay your beneficiaries. But what happens with whole life insurance if the policy expires before you die? In that case, the insurance company returns the money it saved for you when the policy expires. One important feature of whole life insurance is that most plans offer bonuses. Bonuses work as a participation to the insurance company profits and are always calculated as a portion of the sum assured. So if your insurance company announced a 3% bonus in 2013, the payout you or your beneficiaries would receive would be increased by 3% of your sum assured. I hope you have understood the basic difference between term life insurance and whole life insurance. Whole life insurance provides both insurance and savings, whereas term life insurance only provides insurance. And logically, they also have different prices. Because whole life insurance involves insurance and savings, whole life insurance plans are usually around 4 to 5 times more expensive than term life insurance plans for the same sum assured. Now that you know about the basics of life insurance, we want to tell you more specifically about life insurance and taxes. Many people buy whole life insurance in the months of January, February, and March so that they can combine their objectives of investments and tax deductions. But just because everybody does this, it doesn't make it a good decision. In fact, research by academics in India and the United States has found that whole life insurance plans are not the best way to fulfill these two objectives. There are two reasons for this. First, remember that when you buy whole life insurance, you are buying both savings and insurance. The problem is that whole life insurance is not the best way to save. Whole life insurance plans pay you returns on your savings through bonuses. Unfortunately, these bonuses do not get bigger as you save more. The returns you earn on your investment are the same no matter how much you've invested. However, regular savings products like National Savings Certificates, infrastructure bonds, or the National Pension Scheme do pay compound interest. This means that as your investment grows, the earnings you get on your investment grow. Second, the premiums for whole life insurance plans include high commissions that go to the agent selling the policy. There are many other savings options where you don't have to pay any commissions. Therefore, all the money you spend can go into your investment. Alright, whole life insurance plans might not be the best way to invest and get returns. But what should I do if I want to get a tax deduction this year? Well, if you also want a guaranteed return, you can go for any of the following long-term savings products and get the tax deduction under Section 80C of the Income Tax Act. National Savings Certificate, offering 8% guaranteed returns. Infrastructure bonds, offering approximately 8% returns. National Pension Scheme, offering returns based on a mix of shares and income investments. And if you're more of a risk taker and want to get a tax break while investing in the stock market, equity-linked savings schemes allow for complete tax deduction and have had returns of around 10.5% on average over the last 5 years. But what if you really want insurance? Isn't whole life insurance the only way you can combine savings, tax benefits, and get protection for your loved ones in case you die? No. Term life insurance plans offer a much cheaper way to buy insurance than whole life insurance plans. You can then save the difference in insurance premiums into other savings products that pay compound interest and offer the same tax deductions as whole life insurance. One final note. You may have heard of endowment life insurance, money back life insurance, or children life insurance plans. All of these life insurance plans are similar to whole life insurance in that they provide both savings and insurance and are unlikely to be a good way to save on taxes compared to the other savings products we mentioned. We hope we've made it clear that investing in whole life insurance plans is not the only way to combine insurance, investment, and tax deductions. There are better options for getting your tax deduction and fulfilling your financial plans.
Now we will study about India in international context. The Indian insurance market is the 19th largest globally and ranks 5th in Asia after Japan, South Korea, China and Taiwan. In 2003, total gross premiums collected amount to USD 17.3 billion, representing just under 0.6% of world premiums. Similar to the pattern observed in other regional markets and reflecting the country's high savings rate, life insurance business accounted for 78.5% of total gross premiums collected in the year against 21.5% for non-life insurance business. Insurance penetration. Insurance penetration premiums as a percentage of GDP has remained stable at a relatively low level in the early 1990s. Total insurance penetration in India was 1.5% in 1990 and was not much higher by the middle of the decade. By 2003, total penetration had risen to 2.88%, comprising 2.26% life insurance business and 0.62% non-life insurance business. In the context of international comparison, insurance penetration in India is low but commensurate with its level of per capita income. Insurance density. Another measure of insurance development is per capita spending on insurance, that is, insurance density. By this measure, India is among the lowest spending nations in Asia in respect of purchasing insurance. An average Indian spent USD 16.4 on insurance products in 2003, comprising USD 12.9 for life insurance and USD 3.5 for non-life insurance products. The level of spending is comparable to that of the Philippines USD 14.6 in total, Indonesia USD 14.5 and Sri Lanka USD 12.5. It lags behind China, which spent USD 36.3 per capita on insurance products in 2003. One factor that has been slowing down the improvement of insurance density is India's relatively high population growth rate, which has averaged 1.7% over the past 10 years. Demand elasticity and growth potential. India's low level of insurance penetration and density has to be viewed in the context of the country's early stage of economic development. Per capita income in India is currently at around USD 600 but is expected to increase rapidly, which could bring in an era of accelerated demand for insurance. International experience tends to suggest that demand for insurance will take off once per capita income has surpassed the USD 1000 mark. This income level is deemed high enough for households to consider insurance protection, particularly as many people begin to own their homes and cars. The empirical relationship between insurance demand elasticity and per capita income can be characterized as a bell-shaped curve. Elasticity remains relatively low at a low level but increases at an accelerated rate once it has passed the USD 1000 level. The following chart depicts the current position of different emerging markets as well as their expected position by 2013. India's improving economic fundamentals will support faster growth in per capita income in the coming years, which will translate into stronger demand for insurance products. It is also worthwhile to note that it generally takes longer for life insurance demand to reach saturation than non-life insurance in terms of rising income elasticity. Based on the growth assumption provided by Swiss Economic Research and Consulting, it can be seen that the window of opportunity in India's insurance market will remain wide open for a prolonged period of time. Strong growth can be sustained for 30 to 40 years before the market reaches saturation as income elasticity starts to decline. Market characteristics. While India is widely expected to remain one of the fastest growing emerging insurance markets in the world, growth will nonetheless depend on its intrinsic market characteristics. The following section will review some of the key market characteristics of India in a regional and international context. Let us now understand the history of insurance development in India. Insurance in its modern form first arrived in India through a British company called the Oriental Life Insurance Company in 1818, followed by the Bombay Assurance Company in 1823 and the Madras Equitable Life Insurance Society in 1829. They insured the lives of Europeans living in India. The first company that sold policies to Indians with fair value was the Bombay Mutual Life Insurance Society starting in 1871. The first general insurance company, Triton Insurance Company Limited, was established in 1850. For the next 100 years, both life and non-life insurance were confined mostly to the wealthy living in large metropolitan areas. Regulation of insurance companies began with the Indian Life Assurance Companies Act 1912. In 1938, all insurance companies were brought under regulation when a new Insurance Act was passed. It covered both life and non-life insurance companies. It clearly defined what would come under life and non-life insurance business. The Act also covered, among others, deposits, supervision of insurance companies, investments, commissions of agents, and directors appointed by the policyholders. This piece of legislation lost significance after the insurance business was nationalized in 1956 life and 1972 non-life respectively. When the market was opened again to private participation in 1999, the earlier Insurance Act of 1938 was reinstated as the backbone of the current legislation of insurance companies, as the IRDA Act of 1999 was superimposed on the 1938 Insurance Act. Life insurance business. When the life insurance business was nationalized in 1956, there were 154 Indian life insurance companies. In addition, there were 16 non-Indian insurance companies and 75 provident societies also issuing life insurance policies. Most of these policies were centered in the metropolitan areas like Bombay, Calcutta, Delhi and Madras. The life insurance business was nationalized in 1956 with the Life Insurance Corporation of India (LIC) designated the sole provider. Its monopolistic status was revoked in 1999. There were several reasons behind the nationalization decision. Firstly, the government wanted to channel more resources to national development programs. Secondly, it sought to increase insurance market penetration through nationalization. Thirdly, the government found the number of failures of insurance companies to be unacceptable. The government argued that the failures were the result of mismanagement and nationalization would help to better protect policyholders. Thus, the post-independence history of life insurance in India is largely the history of the LIC. From the perspective of national economic policy, the LIC has been instrumental in the implementation of monetary policy in India. Let us now discuss the special features of life insurance. In nominal terms, during that period, the total income of the LIC grew 700-fold. The largest part of payments to policyholders has been through the maturity of policies. This proportion has gone up over time and relative to death benefits. To a certain extent, this reflects the increasing popularity of life insurance products as savings vehicles in lieu of life protection. It can also be discerned that the operating costs as percentage of premiums remained high over a sustained period of time, with a decline in the past 2 decades. Part of this decline has come from the increased sale of group policies, which are cheaper to sell per policy than individual life policies. Amount payable on settlement. According to Article 90 of the Insurance Contract Act, life insurers are required to buy back life insurance policies on the request of the policy holder in whole or in part if the insured event is certain and at least 3 annual premiums have been paid. Profit sharing of policyholders. Life insurance in Switzerland continues to be based on the collection of gross premiums. These premiums include safety and cost surcharges that are not always needed by the insurer and can therefore be reimbursed to the policyholders in the form of profit sharing. Let's move further to the types of insurance. Life insurance is a contract between an insurance companies in which they promise to pay out some amount of money. The 2 main types of life insurance are called temporary and permanent. Temporary and permanent are the 2 main types of life insurance, and which one is best is a hotly debated topic in personal finance. Term or temporary life insurance provides protection for a specified period of time only, like a term of 10, 20 or 30 years. Term is the most affordable coverage because it does not have any fancy features. All it offers is a pure death benefit. The price or premium typically stays the same each year during the term. The downside to term insurance is that once it expires, the price to buy a new policy goes up as get older. What is permanent life insurance? Permanent life insurance, on the other hand, provides a death benefit for entire life, and it is also an investment. A portion of each premium pay goes into an account known as the policy's cash value, and it grows on a tax deferred basis until take a withdrawal or borrow from the policy. The downside to permanent insurance is that it is expensive and comes with fees and commissions that usually reduce annual return on the investment part of the policy when compared to what could earn in the market otherwise. The 3 most common types of permanent life insurance are whole life, universal life, variable life. Whole life insurance. A whole life policy gives a guaranteed death benefit, a fixed annual premium, and a guaranteed rate of return on cash value. Since those guarantees are locked in and cannot fluctuate, whole life is the most expensive life insurance product available. Universal life insurance. Universal life does not offer the guarantees of a whole life policy, but it has more flexibility. The premiums are less expensive, but they can also increase up to a maximum amount. With universal life, get a minimum rate of return on cash value, but it can grow more quickly because have the ability to earn more when the financial markets go up. Variable life is similar to universal except that choose how to invest money from a menu of securities and funds. It offers the most flexibility and risk of all the permanent policies. There is no guaranteed minimum rate of return. If the investments perform well, cash value could skyrocket, but if not, cash value could plummet. Now in the end, let us now summarize what we have learned in this lecture. The Life Insurance Corporation of India (LIC) is undoubtedly India's largest life insurance company. Fully owned by government, LIC is also the largest investor of the country. The insurance industry in India has come a long way since the time when businesses were tightly regulated and concentrated in the hands of a few public sector insurers. The dynamic growth of insurance buying is partly affected by the changing income elasticity of insurance demand. India's low level of insurance penetration and density has to be viewed in the context of the country's early stage of economic development. The empirical relationship between insurance demand elasticity and per capita income can be characterized as a bell-shaped curve.